This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and our personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today is episode number 11. Today's episode is titled, What Type of Entity Should I Choose? LLC, a partnership, a corporation? The reason why I deal with this particular issue now is because the right business structure matters. It matters not only now as you're dealing with your personal planning, but it also matters a lot at the time of sale. Many people believe that business exit planning, if you will, the idea of preparing your business to sell, occurs about the time the sale should take place. Maybe a month or two before, at the most a year before. And that could be furthest from the truth. I'm going to give you an example, but some of the planning that we have to do needs to be done 10 years in some cases before the sale is ever consummated. Sally, for example. Sally was a successful businesswoman. She's worked hard. She's built an unbelievable company. And out of the blue one day in the previous couple of years, a buyer stopped in and made an unbelievable offer to her to buy her business. I mean, this was the dream offer. After she received the offer in writing, mistake number one, never receive an offer in writing until you've got your team completely assembled and everybody's apprised. But nonetheless, after she received the offer in writing, she contacted our office to help her prepare for the business sale. That was number two, obviously. You've got to get your team in place before you ever go into this idea of selling a business. But anyways, we assembled a team real quick. We got the attorney, we got the CPA, put the CFPs together, and we quickly noticed, our office pointed out what type of entity she was formed as. And we got to looking at the offer price, running through the numbers, and we quickly showed her how much she was going to pay in taxes. So the business, upon sale, was going to pay taxes first. Then she would get the remainder of the proceeds, and she was going to have to pay taxes again at a personal level. It's called double taxation. Yeah, double taxation. That sounds like highway robbery. In fact, to me, it reminds me of something like you would see on Robin Hood. You know, the old cartoon with, Robin Hood and Little John runs through the forest. I mean, you would almost think of that type of robbery, but that's not the case. It's actually the way the tax code works. And it didn't have to be that way. Obviously, Sally didn't sell the business. Now we're dealing with a 10-year business plan, and the goal is now we're going to try to sell the business with much lower tax ramifications. So if you're starting out in business now, or you're already in business, it doesn't matter if you're starting or you're already a seasoned business owner. The right type of entity matters a ton. It really does. Now, look, today I'm not trying to provide you extreme details on how to select the type of entities you are. That's not the goal of today's show. There's books on that. Obviously, you're going to need to build your own specific team. You'll need a good certified public accountant, a CPA. You'll need a good attorney. You will. You're going to need a good attorney. You're going to need a good CFP, all to help you make the planning work. But today's just more of an overview, and so I'm not going to go down too deep in today's conversation. We may do that in later shows, but not today. I already have a group of attorneys I'm excited to have on the show at some point in the near future. We're already talking about it, for them being guests to come on. We're going to deal specifically with this subject about the pros and cons of these different type of entities. But let's dig into it. So there's four basic type of entities. So you have what's called corporations. Sometimes people refer to these as C Corps, but they're corporations nonetheless. You have what's called subchapter S corporations. It's a different type in the tax code. You have partnerships. And then you have the most popular LLC among small business owners, and that stands for limited liability companies. Yeah, one day I was doing a speech one time, and I said limited liability corporations, and one of my good friends who's an attorney, he stuck his head up and said, Justin, it's companies, not corporations. I'm like, yeah, I knew that. I misspoke. We do that occasionally. And then there's a fifth one. Yeah, I know I said there's only four entities, but this one's not an entity. And that says if you do not form your business as a corporation, as subchapter S, a partnership, or an LLC, and there's variants of all those, then you're ultimately going to end up being a sole proprietor or a sole proprietorship. And that's not an entity, but it is a type of business nonetheless. Now look, there's many advantages and disadvantages to each of these type of entities. Perhaps the most important feature of formulating an entity, and why many people do create an entity to operate their business under or as, is personal liability protection. The last thing we want to have happen is to have our personal assets, the things we've been working for many years, to become encumbered by corporate problems. There's a thing called the corporate veil. A veil like you would see on your wedding day, like the bride perhaps may wear in front of her face, old tradition. The veil there is to prevent company problems from causing you, the owner of the company, personal harm. And it's quite difficult, not impossible, but quite difficult to pierce. In other words, to move beyond that corporate veil into personal liability or personal assets. It can be done, but it's quite difficult. And the LLC, Subchapter S, and the C Corp does provide a good source for corporate veil. The corporation is the strongest, the C Corporation. But if you're not formed as an entity and you're operating as a sole proprietorship, then you are exposed. You're fully exposed. Now, that may not be a problem. Perhaps you do not have very many assets at this point. Perhaps you have enough assets, but now you're just using insurance as a hedge to help protect your liability. But if you're not formulated as an entity, then you are personally exposed to risk that the company or you could offer. So that's perhaps the most important reason why people form as an entity. Another one that's used often, especially for us as planners, is the transference of stock or membership interest in the event of an LLC. So in a corporation, a C Corp or an S Corp or corporations, you have stocks, but in an LLC, a limited liability company, they're called membership interest. And the cool thing about it is you can divide and move the stock amongst different, perhaps, investors. You can move them around key partners. You can even give certain types of stock to key employees. The corporations are awesome for this. LLCs are pretty awesome in this case, really. I like them for this. But Subchapter S's, they have limits on the number and the type of owners that you can add to the company. So there are some limits here on the Subchapter S. Again, if you're a sole proprietor, not a big deal. You don't even have to deal with the issues of stock. Another reason why people will form a company as an entity is most of us who are listening to the show, or most of my business owners, we're entrepreneurial in nature. We want to control the company in the manner that we see fit. So flexibility is vital. It really is. We want to be able to move and flow. And there's no other entity out there unlike the LLC. The LLC offers the most flexibility. Partnerships and corporations do a fair job. The S Corporation is a little bit more restrictive. But flexibility is nonetheless vital for us. And so people often run into these type of things. They want to be able to deduct certain losses on their personal income tax. Certain of these companies allow you to do that within reason. Again, talk with your professional tax preparer and your professional tax advisor to walk through these. Tax reduction strategies, I use this in planning a lot. Most of us don't realize we can plan how much we're going to pay in taxes. We really can. Many of us don't worry about it, and all of a sudden it becomes tax day, and we just try to figure out how much we have to owe, and those are the ones who typically need a planner. So I like using Entity for tax reduction strategies. There are favorable accounting methods that you can use with entities under flexibility. So, for example, you can have a cash type accounting or accrual, and there's many more. Again, your bookkeeper or your accountant will help you with this. You also have what's called tax-free fringe benefits. I mean, there's benefits you can use on certain of these entities. Again, talk with your tax preparer. So I'll go back to my client, Sally. Has she just filed one document, she would have moved her company from a double taxation system into a single taxation system pretty easily, just with one form. So the type of entity is important.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
But now, let's say you have the desired entity. You've talked with your tax preparer, you've talked with your attorney, you've looked at your planning, and you have the correct entity. You're not off the hook. By no measure are you off the hook yet. No. There are some things that you have to have. There are documents that you have to have. And this is where a good lawyer can help you. So the most popular document is the agreement or the operating agreement. And you see those a lot in partnership type structures. You see them obviously in corporations. The operating agreement is vital, especially if you have partners. The reason for it is it deals with disagreement. How are you going to deal with disagreements? It deals with who's going to do what roles. Are you going to have a chief financial officer? Are you going to have a managing member if it's an LLC? Are you going to have a board of directors? It's going to tell you what you have to do for capital requirements, how you're going to handle a lawsuit, where it's going to be adjudicated at. The list goes on. Partnership agreements or operating agreements could be very, very vast, or if you're one person who's opened up a company, they can be relatively simple. Sometimes the state in which you form the entity has just a form operating agreement. Many times the banks will require these in order to open accounts up. So an operating agreement is vital. Another agreement, which is not required by law, but I think it should be, maybe not required by law, but nonetheless I view it as vital, and that is a buy-sell agreement. And so if you have multiple people who own the company, even if you have majority and minority share interest, it really doesn't matter. What you're working toward on a buy-sell agreement is you're dictating how the company is going to be sold, at what price, and under what arrangements. It will deal with the event of a death or a disability. Again, it's not a requirement, but my goodness, that document is one that you just have to have. So now that you have your documents, you're still not done with your entity selection. You have much more to deal with at this point. You also now have to maintain your entity, and you'll need records for certain activities. So you'll need records if you're selling a stock, if you're loaning money to the company, if you're borrowing money from the company. So if you're selling a stock, let's just go through some of these a little slower. If you're selling a stock, let's say you have 100 shares of the stock and you want to bring on a new partner in the company and you're selling the stock out, you need to document that. If you're loaning money to the company, let's say the company needs to borrow money and instead of you going to a bank, you, the owner of the company, loans money to the company. You have to document that. You need to document that. If you're borrowing money from the company, let's say the company has a big, nice pile of assets right now. They're sitting on a ton of cash. What you'll want to do is make sure you have a document in place if you're going to borrow money from the company. And then if you're placing the company in debt, make sure you document it. If there's legal issues which have arisen, make sure you document it. Issuance of shares, capital calls, meeting minutes, anything that happens as it relates to that company's operation, you want to document. Why? Look, there's tons of books, CPAs, lawyers out there who can walk you through the details on how to do this. But the last thing is you want to find yourself destitute, trying to win a fight without documentation. Like I mentioned before, I've gone through legal battles in business. And when it boils down to it, he said, she said doesn't cut it, folks. It needs to have what it says on the documents, what everybody signed before turmoil arises. And whenever it comes forth, and if you end up running type of legal problems, or if you end up in a disagreement with partners, or even in the transition and the exit of your business, the documents are going to be governed. The judge or the attorneys are going to be perusing those documents. So this is where I go back to your team has got to be awesome. You don't want to skimp on some fly-by-night attorney who's operating out of the trunk of his car. And I've seen that literally. That's scary. Now, you want an attorney who's well-founded in his business for your particular jurisdiction. You want one who's been around the block a time or two on the formation of your documents. But don't just leave it at the attorney. Many attorneys are good at law, but they're lacking in tax. So you're also going to need a good CPA. CPA is worth their weight in gold when it comes to helping you build your business properly. I use a CPA. I recommend CPAs. If you've watched me for any length of time, you'll know that I almost refuse to work with people who don't have a CPA. That's how much I value them. And then you can't stop there. You've got to work with a CFP, a certified financial planner. All three of those professionals think differently. And right now, when you're dealing with entity formation, I recommend that you always build your team of advisors together. If you're already in business and you're looking now at creating a 10-year plan or a 3-year plan to sell the business, and that's why we're going through this, get your team on board. Let the CFP, the CPA, and the attorney all know your plans and let them talk amongst themselves. We talk on a different level many times to other business owners. I've been in meetings with CPAs and attorneys, and we're carrying on, walk out the door, and the client says, I don't have a clue what you guys were just talking about. But yet out of that powwow, if you will, out of our brainstorming session, we come up with some good action plans to help reduce the tax liability and make the transition go smoother. So entities matter. They matter a lot. the way you operate the entity with the documentation and the way that you maintain the entity will matter a lot. And now if we bring that in context of you getting ready to sell your business, if we know we're trying to sell the business in a length of time, we can make sure the entity is positioned so you can minimize the most taxes. Not only that, but we can make sure the documents are in place that'll help make the transition of the business go smoother between you and the buyer and potentially other shareholders or stakeholders in this asset. So that's it for today, folks. That's episode number 11. What entity are you, and are you the right one? Hey, guys, look, as I say oftentimes, life is hard. Law, oh, my goodness, figuring out what entity, that can be near about impossible. Business doesn't have to be frustrating. Money doesn't have to be frustrating. Let's continue to make our lives at least financially simple. Y'all make it a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.